they've been lying to you. And it's not just the crypto bros, okay? But it's Wall Street, the economists, the analysts, the media. Are you surprised? Of course you're not, but you still need to know this. They say rising rates are killing the market, the labor force is collapsing, the recession's already here. But what if it's all bullshit? I know, surprise, surprise. People like Jamie Dimon lie for a living. In this video, we're breaking down the myths, showing you what's really driving markets and how to protect your portfolio from the BS. Now look, you've probably heard it 100 times. When interest rates go up, the market's going to crash, right? Sure. High rates don't exactly light a fire under the markets, but they're also not the end of the world either. Consider that we've got this far in the markets for both stock and crypto with the rates at over 4%. But here's what actually matters. The Fed funds rates, the short-term rate controlled by the Fed, is currently around 4.25 to 4.5%. The 10-year Treasury yield is about 4.5%, which is right in the middle of its range over the last few years, and still below the long-term average of 5.83%. Hardly sounding apocalyptic, is it? The 10-year yield doesn't get as much attention as it probably should, but it is a pretty big, kind of a big deal, guys. It reflects investor sentiment and shapes borrowing costs across the economy, from mortgages right on down to corporate debt and all that kind of stuff. So it's kind of one of the best gauges that we have for economic health and growth expectations moving forward. So even though the Federal Reserve has been holding rates higher for longer, the long-term yields on stuff like the 10-year haven't actually gone crazy. And here's the kicker. Despite all this, the S&P 500, Bitcoin hit new all-time highs. The S&P 500 touched 6,147 in February and is now just a hair below that. Bitcoin even broke $111,000 last month. Now, sure, both have seen 20 to 30% pullbacks, but that's normal. That's investing. Corrections happen, dips happen, even in strong uptrends, even in multi-year bull market periods. That's just part of the ride. That's because markets don't just react to interest rates, they react to what those rates actually mean. If rates are rising because the economy is strong, markets can keep going up. If rates are rising or staying high because inflation's out of control and a recession is looming, then that's a different situation. Markets get nervous. You don't want inflation to go back up. That's the key thing. Okay? Now, rates can be pressure valves, helping cool things off without killing the momentum. Lie number 2, we have a soft job market. Recession's coming, baby. Everyone's gonna lose their jobs, which 3 to 5 years, a shit ton of people are gonna lose their jobs, but that's for later us to worry about. But of course, a softening job market is worrying. No jobs means no money for consumers, and lower consumption means less profits for businesses, and that means fewer jobs, and the cycle continues. Translation, nobody's buying your dog coins. But the truth is, there is nothing wrong with the job market right now. Crazy, right? Right now, the US unemployment is around 4.2%, basically the same as it was before the pandemic. For context, in 2008, it hit 10%. During the Corona beer pandemic, it spiked to nearly 15%. Today's numbers, nowhere near that. Yet, there are headlines about the layoffs, especially in tech, which happen from time to time. A lot of people are getting replaced by AI, but they find other jobs. In fact, the job openings were up by 300,000 last month. Crazy. Zoom out, the broader labor market still tight. In fact, compensation for civilian workers rose 3.6% year over year as of Q1 2025, and that's not all. Again, in April, the job market still saw 7.39 million job openings, which again was up 300,000 from the previous month. Crazy. The third lie, you've probably heard of the credit card debt is up, savings are down, the US consumer's tapped out, it's over. Sounds scary. Yeah, sure. But again, you're not getting the full picture. So let's take a look at a JP Morgan consumer report. According to the report, despite all the noise, the latest data shows consumer spending is actually holding up. The US consumer keeps on buying shit. Yes, tariffs are a concern and a wild card that could play out with some unexpected effects in the coming months. But so far, they haven't caused any major spike prices or dramatically changed purchasing behavior. Some import-heavy goods have got more expensive, yes, but these categories tend to be volatile anyway. Retailers like Walmart are out here warning of big price hikes, but in many cases, companies are probably just going to eat some of those costs rather than try to pass it all on to the consumer, because a lot of the costs are not actually that massive. they can take an extra few percentage points of absorption on this. On the consumer side, spending remains pretty resilient. Now, according to Chase card data, so JP Morgan Chase, right, their card data, discretionary spending in May was actually up. It was up 2.6%. Gen Z and millennials boosted their spending nearly 6%. People keep buying shit, man. JP Morgan now expects consumer spending to actually grow 2.3% for all of 2025. But the US consumer is dead. Apparently not. By the way, they're revising their Q2 forecast higher in this situation. So no, it seems the consumer is not broke and that people still have money for dog coins. Fantastic. Now, perhaps they're adjusting their spending, buying different things, but it certainly is not collapsing. Now, before we bust another lie, guys, if you're trading these cryptocurrency markets, you want to trade Bitcoin, you want to trade Ethereum, you want to trade dog coins, you got to check out BitUnix, hottest place to be trading crypto coins right now. No KYC, no VPN. You can enjoy your privacy, get huge bonuses, up to $2,000 in trading bonuses, $400 in deposit bonuses, and we're giving away $1,000 every day during the live streams, Monday to Friday. You could be eligible if you sign up now. Let's bust the next myth. If inflation stays high, it's game over for the economy. Well, it's problematic, okay? Honestly, nobody really likes inflation. If inflation spikes again, it's going to get everybody pretty damn worried. But there is, of course, nuance to it. First off, some inflation is normal, even healthy, okay? The Fed targets 2% inflation. It means the economy is growing. Wages rise, businesses invest, people spend, plus not all inflation is equal. Inflation driven by demand, that is, people, of course, buying more stuff in a strong economy, well, surprise, surprise, that's not so bad. And that's very different from inflation caused by supply shocks or by, war disrupting the flow of oil or some BS like that, or just bad policy. So yes, moderate inflation is actually fine. And again, the Fed targets around 2%. So if inflation is 2%, everybody's happy. Look at it this way. It encourages spending because people are therefore more likely to go out and to spend money now if they anticipate that prices will rise in the future, boosting, of course, demand in the short term. And then prices tend not to rise as much as people think anyway. Like, get out and buy that fridge, buy that gaming console, because it's going to cost more next year anyway, and your money's worth less anyway, so may as well do it. Every dollar spent on the economy leads to expansion, which of course creates more jobs, puts more money into the hands of consumers so they can buy more shit and buy more dog coins. Now, right now, the inflation's, the CPI, consumer inflation's at 2.4% for May, which is slightly above April's 2.3%. So people go, oh no, the inflation's going back up very slowly, okay? And maybe that's a bit concerning. But it's still below expectations. The analysts were expecting 2.5%, so it's cooler than expected. That's despite all the tariff drama, despite all the crazy shit that's happened so far in 2025. We're only at 2.4% for inflation. It's nothing. Again, the Fed targets 2%, and we were at 9% 2 years ago. Back down to 2.4, man. It's fine. So what's the takeaway here? Markets are messy. Narratives are loud. There's a lot of bullshit out there, okay? A lot of things designed to make you freak the F out. But the truth is usually somewhere in the middle, and the doom shit that sells and the lies from Jamie Dimon's mouth, all this kind of stuff, tends to distort reality. Yes, rates are higher than a lot of people would like, could use some shaving, but they're not sky high, they're not end of the world high. There is new layoffs due to AI, but jobs generally pretty solid. Wages are going up. Now, consumers might be a bit cautious because of tariffs and all these sort of things, but people are still spending. People are adapting. Money's still flowing. The economy's still strong. The U.S. Atlanta Fed predicts a 4.2, I think, percent GDP growth for the USA in Q2. It's hardly a recession or the end of the world, is it? That's actually massive numbers. Now, inflation, yeah, it's still not the 2% the Fed wants, but we're damn close, aren't we? It's manageable here. It's fine. And it's been cooling. Okay, it's not spiraling out of control. It's not spiking like crazy. So don't let the headlines scare you out of the game. The real key is understanding the data, not reacting emotionally to all the headlines that you're seeing. And no matter what the cycle brings moving forward, one thing simply hasn't changed. And that is that investing in strong assets with strong fundamentals, it's still how you win the game. It's still the OG move. Buying those good stocks, buying Bitcoin, buying real estate, all right? It will make money long term. So many ways to make money, so many ways to invest your money that are, if you just consistently keep showing up and investing every week, every month, whatever it might be, you're going to win the game. Obviously, you know, Bitcoin, finite asset to rule them all. Better have some, just in case, right? And if I may add, guys, always manage your risks, okay? Investing, it's not the casino. People treat it like casino, especially stuff like meme coins. And it's fine to speculate with a little bit of your money. I'm not saying that you can't, but take your investing money and your speculation money and have them in separate places, okay? If you want to go roll the dice on some meme coins, fine. It's fine. You probably actually have better odds going down to the casino, but still fine. You can roll the dice on meme coins. But damn it, invest. Invest in actual good shit. Don't just lose all your money gambling, okay? And investing involves looking at the data and making informed decisions. And I hope that this video will help you make better informed decisions and to zoom out and to stay calm. Remember, long-term investing always beats short-term bullshit. Thanks for watching.